Hello YouTube and hello YouTubers, welcome back to my series on the options Greeks. If you're new to this channel, check out all of my other finance videos, and if you'd like to see more videos like this, do hit the subscribe button. This video is the third video in a series I'm doing on the Greeks for options investors. In this video we're going to be learning about delta neutral portfolios. Take a look at my last video if you don't know what delta is, because obviously delta neutral portfolio only makes sense if you know what delta is. So make sure you watch that one first. So a delta neutral portfolio is a portfolio made up of positions with offsetting positive and negative deltas, such that the net delta, the delta of the portfolio, is zero. Such a portfolio typically contains options and their corresponding underlying securities, such that the positive and negative delta components offset each other. In a delta neutral portfolio, you would expect the portfolio's value to be reasonably insensitive to changes in the value of the underlying security. The existence of a delta neutral portfolio was shown as part of the original proof of the Black-Scholes model, so it's actually quite an important concept in finance. As we learned earlier, delta is the amount that the options price changes for a 1 unit change in the price of the underlying. Thus, a delta neutral portfolio is one where for small changes in the price of the underlying, the portfolio would not change very much in value at all. When traders are hedging using options, they would usually be aiming for their portfolio to be delta neutral. Now, why would they want this? Well, the reason you'd want to be delta neutral is if you're buying and selling an awful lot of options, we'll say as a market maker, you might want to reduce the risk that a large move in the market could cause either big profits or losses for you, because maybe you feel that your ability is not really in predicting the direction of markets, but it's just in buying cheap options and selling overpriced options. So the real reason that an option trader might want to be delta neutral is when we looked at options pricing, we worked out that the price of an option, it comes from two places. One is the price of the underlying instrument, and the second thing is the volatility of the underlying. So if you're able to get delta neutral, if you're able to hedge out the delta or the directionality of the options, then your main risk exposure is to volatility. And so now you're trading volatility. You are making money if you are right about the correct level of volatility and how that differs from the implied volatility in the price of an option. So that's kind of a quick introduction to delta neutral portfolios. We're going to talk more about that in my upcoming video on dynamic hedging, which I think comes out maybe in about a week. Make sure to watch that one, and don't forget to hit the like button if you've made it this far in the video, and subscribe if you'd like to see more videos like this. Talk to you later. Bye.